I expect market to proceed in a range trading fashion, with risk-on and risk-off period alternate throughout the years as the number of event risks driving the market volatility higher. In US, the newly elected President Trump and his administration will add a new dimension of uncertainty, and the data-dependent Fed will make every meeting of theirs a standalone event risk.
Stronger than expected inflation would force central banks to be much more aggressive because yields are very low right now. More aggressive central bank action, which would push short-end yields higher, while high inflation expectation would push long-end yields up. And this would also negatively impact risky asset prices as well. So while this is not the base case scenario, this risk could be the event that affects the market the most in 2017.
Global political and policy uncertainty, which could weigh on macro and corporate fundamentals, and in particular, rising protectionism or anti-globalization following the Brexit and under a new US administration. There are also elections in France and Germany.
Political risk either in the developed world or in Asia can change the investment landscape dramatically and hence can be difficult to position for.
But we should also remind ourselves that these big geopolitical events rarely have the huge effect and consequences that we expect when we're living through them. If we look on a longer time perspective, actually they play a much less important role than the fundamental economic and market developments.
Now, what has been fascinating in the aftermath of the Brexit result is that the cyclical consequences have not been as much as the pessimists feared. So a number of prominent economists were calling for a UK recession in the aftermath of Brexit. That hasn't panned out that way. And so it could be that the cyclical consequences are not as much as we feared, even if there is a high degree of structural uncertainty and the likelihood of structural costs to growth on a longer term time frame if the anti-globalization, anti-trade agendas are fulfilled.
Made on a 10-year horizon, it's clear that the returns on equities and corporate bonds are likely to be much better than those on cash and government bonds. So our default position is to be risk on. We then look for scenarios where those long-term returns might not play out, and there's a variety of risks around those that we can see. However, for 2017, it looks like none of those risk scenarios are strong enough to take us from our default risk-on position.
There's a lot of uncertainty and noise, unusual uncertainty in financial markets today. And that means that the return to skill, the return to active management has increased. So we recommend that investors adopt an active, a dynamic approach, an opportunistic approach which seeks to take advantage of excessive moves in financial markets. And we think that this is going to serve investors well in a particularly uncertain environment as we move ahead.